Hey, what's up, stock compounders? Brad here. So today I want to talk to you about Semler Scientific. This is a company that came to my attention through Yen Liow. He added in his fund Araved Global in the third quarter of this year. And in this video, the Equity Mates podcast, he gives a quick pitch for this company. It's like 1 or 2 minutes. There is so much information here, a lot of which you're not even going to be able to find in the annual report or the company earnings calls. They're actually pretty tight-lipped about a number of different aspects of their business. This may be pointing to what Pabrai talked about in a Q&A session not too long ago about how great businesses, monopolies, they really try to conceal the fact that they're monopolies because they don't want the attention, they don't want the regulators coming after them. They don't want attention from competition either. So that came to mind. But let me just share with you the quick pitch from Yen. And then I want to get into Niraj Gupta's presentation a little bit from 2019 at Manual of Ideas. Almost 3 years ago, he presented on Semler. And then there's a few other odds and ends I'm going to throw in there. So the quick pitch from Yen. You've got an 800 million MedTech company in the US. Now it's less than 800 million now. It's like 650 million. It's down significantly from when Yen pitched this. Their main product is a product called QuantaFlo. Okay, QuantaFlo detects peripheral artery disease, which is a big issue. Okay, peripheral artery disease is a way to detect in advance when someone has a much higher risk for heart attack or stroke, sort of a buildup of plaque in the arteries in the legs primarily. So the way QuantaFlo works, you put a sensor on your finger, a sensor on your toe, and there's these diagnostics that happen in the cloud. And after 3 minutes, they can tell where the patient is on the spectrum of peripheral artery disease, PAD. The business is growing mid-30%. I calculated over the last 3 years, the revenues are growing 35-36% per year. So that's doubling every 2 years. It's got 91% gross margins, 50% EBITDA margins, trading at low 30s cash flow next year. Like I said, it's down from that. I think it's like 28 times next year's free cash flow. This is a 5% penetrated of the first addressable market. Okay, so what I calculated is it's about 2% penetrated in terms of the total market for QuantaFlo in the US. There's only 2% of that right now is controlled by that product. It's disrupting the standard of care, becoming the standard of care. And I'll talk more about standard of care a little bit later. The return on investment for their clients, which are insurance companies and home risk assessment, is 50 to 100 times their return on investment, right? So the amount that they're paying Semler to use QuantaFlo, they save 50 to 100 times in the same year as they're paying out to use this product. So that's incredible. This is a company we think is incredibly disruptive. We believe there are 4 different shots on goal. So I haven't been able to find this number 4 anywhere else, not from the company, not anywhere. Okay, how Yen knows this, I'm not sure. This is shot number 1. So QuantaFlo, their first product. In the latest earnings call, they've mentioned they do have their first customer for their second product. Okay, we don't know what the second product is, but it's cool to know this QuantaFlo is just one of potentially 4 product lines that Semler is going to be rolling out. And like I said, that first product line with QuantaFlo is somewhere between 2 and 5% penetration into that total addressable market. Has a very high recurring base. Okay, so this is subscription model like revenue here. where you get an insurance company on board with the product, and they're just paying that licensing fee year after year after year. It's a very sticky product because it's an order of magnitude better than the product that it's disrupting. The second product has just started hitting the market with its first client. We'll have a second TAM at an incredibly reasonable price. If this business was a $3 billion company, like I said, it's 600 to 700 million. If it was a $3 billion company, it would trade at a far larger valuation. These mid-cap stocks, seems like a small cap stock to me. He calls them mid-cap. He tends to lump small and mid together, SMID-cap stocks. He says these mid-cap stocks have pockets of inefficiency trading for crazy reasonable prices, and we believe Semler is one of them. So that's, you can listen to that starting at $25.55 here at the Equity Mates podcast. I'm going to share a few points from Niraj Gupta. This is from almost 3 years ago. Let's see. QuantaFlo is a convenient alternative to the industry standard. Adoption by insurance carriers is incredibly efficient channel for the company. Okay, when these insurance companies decide, we're going to use QuantaFlo over, the incumbent product for detecting PAD, you basically have the insurance companies selling the product for you. Okay, so you don't necessarily need to grow your sales team in order to scale, which is awesome. Niraj talks about the best-in-class Rule of 40 SaaS metrics. So he pulled up a table of different software as a service companies looking at different metrics. I can show you guys the one that I came up with today. So SaaS Rule of 40. So what is the Rule of 40? It basically says you look at the sales growth and you add the operating margins. Okay, take off the percents, just look at the whole numbers, and you get the Rule of 40. If the number, adding those two together, is greater than 40, it's a healthy SaaS business. Okay, obviously this is a very broad stroke here. But it's interesting to look at some of these different software as a service businesses that have similar scores in terms of the Rule of 40 framework, and to look at what they're being valued at by the market with respect to sales and with respect to earnings. Here's Semler, number 3 on the list, with a combined score of 80. Okay, that's the Rule of 40 score. So twice that 40, which is the threshold of being a healthy SaaS company. Now, if you look at comparisons in the U.S., you've got Square here with 111 times earnings. That's next 12 months price to earnings ratio. And you look at the operating margin for Square, 2%. Okay. There's a nice balance here between sales growth and operating margin. 36 and 44, those are very strong, both growth and margins for Semler. So anyways, Niraj made this comparison in his MOI talk, so I figured I would update the numbers here just to get a sense for looking at Rule of 40 metrics, other SaaS companies, how comparable are they in terms of how they're being priced? So take that for what it's worth. Let's see. Niraj points out the primary care physician and nurse practitioner market for QuantaFlo is around 250,000 offices. Okay. So if you're selling a $6,000 annual licensed product like QuantaFlo to 250,000 offices, let's take the low end of that range, there's a total market size here of 1.5 billion. And right now, the revenues for those licenses right, for those annual licenses is about 30 million. Okay, so that's, you know, exactly 2% penetrated. So a long runway for growth potentially with Semler here. Talk a little bit about why does peripheral artery disease matter. PAD patients have a 21% chance of suffering a heart attack or stroke, or being hospitalized or dying of complications within 1 year. Okay, so it just increases the risk for those things. It's a leading indicator for someone to have a heart attack or stroke. So like I said, for these insurance companies, it's a lot cheaper to do this testing up front to really assess the risk than to wait for these events to actually happen and then deal with it on the back end. The industry standard, so didn't talk about, Yen didn't talk about this, but Niraj gets into this. The industry standard for testing is ankle brachial index test, okay? And it really measures the ratio of blood pressure between the ankle and the arm. Ratios below 0.9 suggest the existence of peripheral artery disease. Now, QuantaFlo measures blood volume changes in the extremities using a technique known as volume plethysmography. Okay, I'm sure I butchered that. Plethysmography, which calculates results via proprietary software algorithm. The test consists of placing a sensor on the finger and toes for 15 seconds each. It takes 2 to 4 minutes to perform this test, as opposed to the 15 to 20 minutes it takes to perform the ankle brachial index test. QuantaFlo has demonstrated substantially equivalent accuracy in determining the presence of PAD, which is why it's, you know, quickly becoming adopted by these offices and these insurance companies. Let's see. The target market is primary care physician offices, clinics, and nurse practitioners. We already talked about the estimated market size. The secondary market is home risk assessment market. Okay, and with the home risk assessment market, it's a different model in terms of revenue. So there's a $40 fee per test with QuantaFlo, okay, for this other market, the home risk assessment market. And the revenues for the last 12 months from that home risk assessment market, the fee-based, the pay per test model, around 22 million. Okay, so it's not as big as the annual licensing market, but it's growing much faster. The growth with that license fee market is 21% over the last 12 months. With the per test fee segment, the growth is 154% over the last year. Okay, so it's important to keep in mind that there's really two different models operating for QuantaFlo in terms of generating revenues. Okay, let's see. So let's talk about gross margins a little bit here. I'm going to pull up ticker. So if we look at Semler, we look at gross margins. They about 5 years ago they were around 75% gross margins. They're up to 91% now. Okay, that's incredible pricing power that QuantaFlo has for its subscriptions, for its subscription and single-use tests. So that's very compelling to see. That gross margins rising so significantly. A little bit about the framework that Yen Liow uses, because he bought this in Q3. It's helpful to understand what kinds of businesses he's looking for. So this is from a different piece of media from Yen Liow, The Game Within the Game at the Microcap Summit. This is a fantastic talk. It's 50 minutes. Check it out. So in this presentation, he says Semler Scientific, he mentions very briefly about Semler in this talk. Semler Scientific is a MedTech company based in the United States with some of the best SaaS-type economics we've ever seen. Delivering it on a single product at the moment, but we believe there are multiple shots on goal with a very large TAM, total addressable market. So in the more recent episode, he talked about 4 shots on goal, with the second one having just been adopted by the first customer. So Yen focuses our business model on the replication phase of the business cycle. Okay, so here's a slide from this presentation, the business life cycle. So in the beginning, there's a proof of concept, okay? And there's a very wide skew in terms of outcomes for proof of concept businesses. Basically, we don't know if they're going to work yet, okay? They haven't won their niche at this proof of concept stage. The next stage is the replication stage. Okay, this is where they've won and they're scaling. Okay, this is really where Yen likes to invest. When a company has just won, okay, like QuantaFlo, clearly an order of magnitude better than the next best product for, testing for PAD, and with a huge runway in terms of growing into that total addressable market. So clearly, Yen sees Semler as being, here at the intersection of microcap. It's actually small cap. It was a microcap maybe 2 or 3 years ago, but really just at the beginning of this scaling phase. These are businesses that have won their niches. The relative size of the niche to the company is very large. So like I said, revenues are around 54 million over the last 12 months. This is a $1.5 billion niche, okay? And that's just for that first market, for the annual kind of license fee segment of the market, not for the, home risk assessment market. So, a lot to be excited about there with the market size in relation to the size of the business. And of course, other shots on goal, presumably coming soon. I did a little digging also in corner of Berkshire and Fairfax to find out about Semler, if anybody was talking about it in there, what people were saying, because there's a lot of great investors who are in that community of corner and Berkshire and Fairfax. There's one guy, he was concerned about the patent, okay? Concerned that this company is a one-trick pony, right? They really have one product, and that's QuantaFlo. And they have one patent, and the patent is for QuantaFlo, but the patent expires in 2027, okay? So this guy is thinking, well, yeah, things might look great while they have this patent that kind of fends off the competition, but what about when that expires? Like, how easy is it to replicate this product for competitors? And based on the fact that the gross margins are so large, why couldn't a competitor just come in at a lower price point and really steal market share away from Semler? That seemed like a reasonable thing to be concerned about. So I was able to actually send Yen a message. Okay, I sent Yen a message and expressed this concern, right? What happens when this patent expires? How is Semler going to defend their moat? And I really appreciated Yen's response on this. He said, MedTech is not patent-based, but standard of care. Okay, the data is important and they have a long learning curve in play. So, so say the patent expires, right? It's 2027, the patent has expired. This is the new standard. It's the new industry standard, okay? And in order for something to displace this thing, it's probably going to have to be an order of magnitude better, right? There's a stickiness here. There's data that Semler has over the years where, you know, they're a lot more trustable than some new player coming in. So there's a certain amount of stickiness, is my sense, in the med tech space, where it's not just the patent that allows you to defend, you know, your competitive position, to defend your moat. There's a history. There's a history there. So that gave me some food for thought, and I'm curious, you know, if you guys have thoughts on that as well. But it made me a little less concerned about, you know, the company only having one patent and the patent expiring about 5 years from now. So that was pretty awesome to get that insight directly from Yen. Let's see, what have I not covered? Oh yeah, I want to talk briefly. This is an awesome resource, guys. Ticker has transcripts. So for any earnings call, you know, you can just read through and you can Control F. You can find exactly what you're looking for. But this is pretty recent. Call on November 1st, you know, just a month and a half ago. And they mentioned this new product coming out. You can also get growth numbers here, both for the, where is it? Variable fee software license revenues and the fixed fee software license revenues and growth. But down here, so we provided some limited information about our recent arrangements with 3 private companies. We can now report that at the end of the 3rd quarter, we signed up our first customer for the new software product that we are distributing for one of these private companies. The service to this customer may begin in the near future. Management may give more information about the product if it becomes material to our business. Okay, another way of saying, if revenues get to an extent where, you know, it's worth sharing, you know, with shareholders. I don't know what level that is or what point they're going to kind of pull back the curtain on what this second product is. But it's exciting to know that they do have another product that's actually being deployed. Even if we don't know anything about it, it's sort of like a call option, right, on this investment in Semler through the lens of QuantaFlo, right? It's another potential opportunity to just knock it out of the park with this investment. So I'm going to be very curious to see what this product is over the coming quarters. Hopefully we get more and more light shed on that. And then I ran a quick calculation here, guys, for return on incremental invested capital for Semler. This is something I've been paying more attention to. Guy Spear talked about it recently. John Huber, this is kind of a template from John Huber that I'm using. But what I did was I looked at, you know, over the last 3 years, how did net income change? And then how did the total capital invested change? Okay, and I did that by looking at the change in equity, the change in debt and capital lease obligations, which there is no debt. There's, you know, very minor capital lease obligations. There's no goodwill, so that didn't have to be factored in. So the total capital invested, the difference between total capital invested in 2018 and 2021 is that incremental capital invested. So if you look at the cumulative 3 years of earnings between, so basically 2019, 2020, and 2021, you've got 50 million in earnings cumulatively over the last 3 years. The incremental capital invested is shown here. It's just the difference between 2021 and 2018, about 40 million. So you've got a reinvestment rate of 80%. Okay, of the 50 million that was earned over the last 3 years, 40 million was invested back into the business. So you've got a reinvestment rate of 80%. Return on incremental capital investments. So you've got this net income change between 2021 and 2018 divided by the total capital invested over that period. Gives you your return on incremental capital investments. Okay, and that's 40%. So the idea here is if you're able to reinvest 80% of your earnings back into the business, and you're able to generate 40% return on capital on that reinvestment, the value of compounding over time with that reinvestment engine is 32%. Okay, so that is very strong. Obviously, I mean that's a double every 2 or 3 years, somewhere in the range of 2 or 3 years. So if they can keep that up, if they can grow into this, big 1.5 billion market from where they are today, around, depending on how you look at it, if you're looking at just the fixed fee or the fixed fee and the variable fee, there's a lot of room for growth. And if they can do it at this rate, it's an incredible opportunity. So that's just kind of a quick look at return on incremental or reinvested capital. And I think that's mostly what I got here, guys. Let me know if you've looked at Semler, what you found about it, and actually what you don't like about it. I'd be very interested in. It feels like, I've got a lot of bullish points on Semler right now, and I'd like to have a little bit more in the bearish camp, just to shed light on some blind spots. Yeah, so any help with that would be greatly appreciated, but it's looking pretty compelling at this point, so I'm excited to dig more into it. It is definitely at the top of my watch list right now, particularly since it's down. Okay, it's down from when Yen Liow bought in. So he bought in the third quarter, right, which is between here and here. So he couldn't have gotten it for less than 100. And right now it's 95 or 96. So that's compelling as well. But I think that's all I've got for you today, guys. Sorry, I feel bad that this is such a bullish, it feels like I'm just focusing on things that are really promising about the business. So help me out with that balance. Let me know what red flags you're seeing in this company. Obviously, one red flag is just not really knowing what their other products are. And it potentially being a one-trick pony. If those other products don't play out, and maybe they do face some pressure from competition once this patent expires. So that's always a real possibility. But yeah, that's all I got for today, guys. Thanks for watching, and I'll see you all in the next one. Take care.